Have you ever wondered how wealthy individuals grow their money without paying taxes year after year? Today, I'm going to show you one of the most powerful and completely legal tax strategies that the IRS actually permits, using permanent life insurance as a tax-free wealth accumulation vehicle. And by the end of this video, you'll understand how people are building $500,000 plus in tax-free wealth using this method. Let me start with the fundamental question. Why would someone use life insurance as an investment strategy instead of just buying stocks or bonds? The answer lies in how the tax code is written. While investments like stocks generate capital gains taxes, dividends, and annual tax liability, permanent life insurance operates under completely different rules. First, let's understand the basic mechanics of cash value life insurance when you purchase a permanent life insurance policy, and I'm specifically talking about whole life, universal life, or indexed universal life policies. You're not just buying a death benefit. You're also creating something called cash value. This is essentially a savings account that sits inside your policy. Here's how it works in practice. Let's say you're a 45-year-old business owner earning six figures. You purchase a $1 million whole life insurance policy. Of your monthly premium, let's say $3,000, only a portion goes toward the actual death benefit. The rest accumulates in the cash value component. This cash value grows tax-deferred, meaning you don't pay taxes on the growth year after year. But here's where it gets interesting. According to the National Association of Insurance Commissioners, properly structured permanent life insurance policies can accumulate cash values at rates that significantly outpace traditional savings accounts. In 2023, while savings accounts were earning 4-5%, many whole life policies were crediting rates between 5-7% annually, with some indexed universal life policies showing even higher potential returns during market upswings. The IRS guidelines that make this legal, you might be thinking, this sounds too good to be true. Surely the IRS taxes this. Here's what's crucial to understand. The IRS doesn't tax the growth inside a life insurance policy. This is written directly into the Internal Revenue Code Section 7702, which defines what qualifies as a life insurance contract. The specific rule is that as long as your policy meets certain requirements, primarily that the death benefit is substantial relative to the cash value, the growth inside the policy is tax-free. This is called inside buildup, and it's completely legal and legitimate. According to tax attorney Marcus Schmucker, who specializes in high net worth tax strategies, Section 7702 essentially creates a tax shelter within the life insurance contract. As long as the policy passes the IRC Section 7702 test, the cash value can grow indefinitely without triggering any tax liability, even though you have complete access to those funds through loans. This is the key distinction that most people miss. You're not just deferring taxes, you're potentially eliminating them entirely through policy loans, which we'll discuss in detail. The real-world accumulation example, let me walk you through a concrete example of how this builds to $500,000 plus in actual wealth. Consider Sarah, a 40-year-old marketing executive with a stable six-figure income. She decides to implement this strategy. Year one, she purchases a whole life policy with a $1 million death benefit, paying $15,000 in annual premiums. After policy fees and commissions, approximately $8,000 flows into cash value. Her cash value balance, $8,000. Year 2-5, she continues $15,000 annual premiums. The cash value grows both from deposits and from the insurance company's dividend reinvestment. Whole life policies pay dividends when they perform well. By year 5, her cash value has reached approximately $45,000. The growth compounds because she's earning returns on the accumulated balance. Year 6-15, continuing the same strategy, but now dividends are being reinvested. By year 15, her cash value has grown to approximately $285,000. Notice that she's only deposited $225,000 total, 15 years times $15,000, but she has $285,000 in cash value. That $60,000 difference is purely from tax-free growth and dividend reinvestment. Year 16-25, with compound growth now really kicking in, and assuming conservative 5% annual returns, by year 25, her cash value reaches approximately $625,000. She's deposited $375,000, but has created over $625,000 in wealth, all growing completely tax-free. This is not theoretical. According to data from Lincoln National Life's Wealth and Affluence Monitor, from 2022, high-net-worth individuals who use permanent life insurance as a wealth strategy reported average policy cash values exceeding their cumulative premiums by 40–60% over 20-plus year periods. How to access this money tax-free? Now comes the crucial question. How do you actually access this $500,000 plus without triggering a massive tax bill? The answer is through policy loans. Here's how this works. Instead of surrendering your policy, which would trigger taxes on any gains above your basis, you simply take a loan against your cash value. The IRS considers policy loans to be non-taxable events. You're borrowing against your own money, the cash value, so it's not income. Using Sarah's example, when she reaches year 25 with $625,000 in cash value, she can take a policy loan of, say, $250,000. This is completely tax-free. She receives $250,000 in cash and pays interest on that loan, typically 4–8%, depending on policy terms. Importantly, that interest is paid back into the policy, further building her cash value. There's an important caveat here that many salespeople gloss over. If you take policy loans and don't manage them carefully, the policy could lapse, which would create a taxable event on the gains. This is where professional guidance is essential. The strategy works best when structured as a policy loan offset strategy, where you take loans against the cash value but allow the death benefit to cover the loan balance if you pass away. This way, your heirs receive the full death benefit less the loan outstanding, and your family is protected while you've accessed your wealth tax-free during life. Common mistakes and counter-arguments. Let me address some legitimate criticisms of this strategy. Criticism #1. Isn't the cost of insurance fees eating into returns? Yes, there are costs. Whole life policies include mortality costs, administrative expenses, and agent commissions. These typically run 1–2% annually on the cash value. However, proponents argue that the tax-free growth more than compensates for these costs when compared to taxable investments. For someone in a 35% tax bracket, federal plus state, they'd need a 5–4% return on a taxable investment to match a 3–5% net return in a life insurance policy. Criticism #2. Why not just max out your 401k and use tax-deferred accounts? There are contribution limits on 401ks and IRAs. In 2024, you can contribute only $23,500 to a 401k and $7,000 to an IRA, plus catch-up contributions if you're over 50. But there's no legal contribution limit on permanent life insurance premiums. This is why high-net-worth individuals use this strategy. It allows unlimited tax-deferred accumulation. Criticism #3. What if I need the money before retirement? You have access through policy loans. Unlike a 401k, where early withdrawal before age 59.5 triggers a 10% penalty plus taxes, you can access policy loans at any time, penalty-free, tax-free. This makes it more liquid than traditional retirement accounts. The IRS scrutiny factor. One important point. The IRS does scrutinize these policies. Specifically, they want to ensure the policy is a legitimate life insurance contract and not just a tax shelter masquerading as insurance. This is where modified endowment contracts, MEC, come in. If you overfund a policy too quickly, it can be reclassified as a MEC. When this happens, loans are treated as taxable distributions. Your strategy falls apart. According to tax advisor David Leeper, the line between a perfectly legal life insurance tax strategy and an IRS nightmare is determined by the modified endowment contract rules. This is why you absolutely need a specialist to structure these policies correctly. The difference between a policy structured by a knowledgeable advisor versus a random insurance agent could literally mean hundreds of thousands of dollars in unintended tax liability. Final thoughts and implementation. This strategy is genuinely powerful, but it's not for everyone. It works best for high-income earners, $150K plus annual income, people who have already maxed out their retirement accounts, business owners looking for additional wealth accumulation vehicles, those who want a strategy that provides both a death benefit and wealth-building people with a 20-plus year time horizon. This strategy needs time to work. If you're interested in exploring this, consult with a fee-only financial advisor and a tax specialist who understands life insurance, not just a commissioned insurance agent. The difference is critical. The fundamental